Let me bring you up to date on what is happening in Japan. The Japanese country has suffered for many years from deflation. Deflation is a very difficult problem for governments to deal with because what it means is that prices are declining. And when prices decline, people behave rationally, they postpone their spending, companies postpone their capital investment, and you slip into a downward spiral. And as everybody postpones their spending, that downward spiral accelerates. That is why the world central banks, since the GFC, have gone to such extraordinary lengths to try to prevent deflation breaking out in their own countries with all these imaginative monetary policies that come under the broad heading of quantitative easing. In Japan, the Abe government was elected with a very clear, coherent program which was designed to put an end to deflation and to transform the Japanese economy and put it back onto a steady progress of growth. The program had three components to it. There was a fiscal leg, a monetary leg, and a structural leg, which they referred to as the three arrows. This comes from an old samurai tale. An old samurai was telling his three sons that they needed to fight together, and he used as an example, he took one arrow and snapped it, and then he took three arrows, tied them together, and showed all of them that you couldn't snap three arrows if they're tied together. That's, for anybody who's interested, that's the background to why it's called the three arrows. The three arrows program so far seems to be working. In terms of the monetary arrow, the Bank of Japan went in with a very aggressive quantitative easing program. The impact was to weaken the yen, but importantly, that weakness of the yen happily coincided with a time of weak commodity prices and oil prices in particular, so the terms of trade were not as negatively affected by a weak yen as you might expect. Perversely, however, the weakness of commodity prices, in particular oil and gas prices, has meant that the Bank of Japan hasn't been able to hit its target of 2%. But it's for good reasons that they haven't hit the 2%, not negative reasons. It's not that the Japanese economy is slowing down again. And it's just a matter of time before they will get to their 2% target. Importantly, we're also seeing wages increase for the first time for many, many years. And so that has a reinforcing influence because in developed economies, consumer expenditure accounts for 70-75% of the activity. So if the Japanese consumer is spending more, that will further stimulate the economy. Interestingly, the weakness of the yen has had a very positive effect on Japan's tourist business. And so many foreign tourists, including Australians, have discovered the pleasures and wonders of visiting Japan, and that is also further stimulating the economy. The structural changes, which are part of the third arrow, are very important. They're going to be difficult to introduce, and it's going to take time, but their long-term impact is very, very positive for the growth of the Japanese economy and importantly for corporate profits and the performance of the stock market. Among those changes, the most important is the recent adoption of a corporate governance code which is based on the British Stewardship Code. And this is extraordinarily important because the wealth that Japan has created since the Second World War is largely locked up on the balance sheets of Japanese companies. The managements of Japanese companies have felt that that wealth belonged to them rather than to the shareholders. And this is a fundamental difference between Japan, if you like, and Western economies. But these corporate governance changes will bring about a profound transformation of those balance sheets. The reason why Japanese balance sheets have a low return on equity is because there is too much equity. There's too much cash, there are too many short-term investments. If you have independent directors on your boards, which you will do as a result of adopting this Western-style corporate governance, then those independent directors will have a fiduciary responsibility to distribute that wealth to the people to whom it belongs, i.e. the shareholders. And so we can prepare ourselves not just for one period, but for years now of a steady increase of payout ratios, increased dividends, and the buying back of stock. This also will appeal to the Japanese institutional investors, particularly the pension funds, who are having to meet the obligations to an aging population. That's an important phenomenon. And the icing on the cake from an investor's point of view is that Japanese companies are not richly priced in the stock market, unlike other developed stock markets where valuations are higher.